Depreciation is an accounting method used to allocate the cost of a tangible asset over its useful life. It is a non-cash expense that is used to reduce the value of an asset on the balance sheet over time. The purpose of depreciation is to match the expense of using an asset with the revenue that it generates. Depreciation is typically calculated using one of several methods, including straight line, diminishing balance, and sum of the year's digits. The straight line method of depreciation is the simplest and most commonly used method for calculating depreciation expense. It is calculated by dividing the cost of an asset minus its salvage value by the number of years in its useful life. The formula for calculating straight line depreciation is cost of asset minus salvage value divided by useful life in years. For example, if a company purchases a piece of equipment of 1 lakh rupees with a useful life of 5 years and a salvage value of 10,000 rupees, the annual depreciation expense using the straight line method would be 1 lakh rupees minus 10,000 rupees divided by 5 equals 18,000 rupees per year. The advantage of using the straight line method is its simplicity. It allows for a constant depreciation expense each year, and it provides a more accurate reflection of the asset's usage over its useful life. The diminishing balance method of depreciation is a method of calculating depreciation expense in which the depreciation expense is calculated as a percentage of the remaining book value of the asset at the beginning of each accounting period. The percentage used is a fixed percentage, which is applied to the remaining book value of the asset, and the result is the depreciation expense for the period. The formula for calculating diminishing balance depreciation is depreciation expense equals cost of asset minus accumulated depreciation multiplied by depreciation rate. For example, if a company purchases a piece of equipment of 1 lakh rupees with a useful life of 8 years and a depreciation rate of 30%, the first-year depreciation expense will be 1 lakh rupees multiplied by 30% equals 30,000 rupees. In the second year, the remaining book value of the asset would be 1 lakh rupees minus 30,000 rupees equals 70,000 rupees, and the depreciation expense for the second year would be 70,000 rupees multiplied by 30% equals 21,000 rupees. The advantage of using the diminishing balance method is that it recognizes that the asset's usefulness decreases more rapidly at the beginning of its life, and it allows for a higher expense in the earlier years of the asset's life.